There we go. All right. Welcome in, everybody. This is our, last AI circle of the year. December, what is this? The 18th, a week away from Christmas. So hope everyone's had a great year. To me, it seems like it's flown by. So kind of bittersweet, the last AI circle of the year, but also excited for 2025. So just as always, to double check, if you could just say hi in the chat or something, make sure you can hear me. We are back in our usual places for the AI circle, but you never know. Technology is weird like that sometimes. So once again, welcome in, everybody. I'm going to bring Kelly on. Kelly, how are you?
I'm hanging in there.
So funny. We had this whole plan. We were very prepared of what we wanted to talk about today, with it being the last AI circle of the year. And then the market decided that it had other plans for the last hour. And I think we might need to pivot a little bit. So awesome. Well, before we say anything we're not allowed to, I'll get the the disclaimer out of the way. Hey, Roderick, thanks for saying hi in the chat. So iFlip Investor Inc. and iFlip Financial Services are not financial advisors and do not make, buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk. You should speak with your CPA or financial representative to ensure the iFlip Smartfolios you select are suitable for your investment profile before trading in a live brokerage account. With that out of the way, we might even need to kind of scrap this, but here was the agenda I was going to go for. Kind of talk about the market a bit, kind of do a year-end review, where we started, where we ended. We haven't made, actually, I guess we made a few trades recently, maybe something to chat with there. And then we kind of teased it last week. We'll give you a little bit more info on these new Smartfolios that are coming for 2025. You guys should see them in your account here fairly soon. But just know those are coming. And then, as always, we'll do a Q&A portion in the last, I would say, half or so of this call. I would not be surprised if this was a long one. So please get your questions in early, and we will answer them as we can. So, Kelly, with all that being said, I don't know if you want to share screen or if you have things to start with, but feel free.
All right. Well, I think I got a screen up there shared. Do you see it?
I can see it now.
Okay, everybody. Look, first of all, happy holidays. Merry Christmas. We're here, end of year. I feel like the year also has gone by very quickly. It's been a long year. The markets do what they do every year. People do what they do. The Fed does what they do. The government does what they do. And if you had to just kind of take a broad look about the year, it's pretty clear it was a good year for the markets. Interest rates did come down in 2024. There was an excitement that they would come down. But what dominated the year, we all know, it was the election. It was the front and center on everything this year. And the election really created a pivot point for the country going forward. And the pivot point, of course, is how does business respond to a new regime or staying with the old regime? Well, we kind of found out. Obviously, when the election was over and the Republican Party won, and they won in a very solid fashion, taking the popular vote, which we knew about this in the last AI circle. What we didn't really expect completely is what they think called the Trump bump. The Trump bump was basically the day after the election. I know these are sometimes hard to read, but if you can see where my mouse is here, this was the day after. Maybe if I make these a little bit different kind of bars, you'll make them a little bigger. There you go. This first day was November 6th, the day after the election. Trump won. The market on the Dow Jones gapped higher, pulled away, and then rallied literally from where it was on election day, 42,000, and it got all the way up to just literally like 10 days ago, it was all the way up to almost 45,000, a 3,000, like an 8% move. All of that, as you know, today the market was down about 3% on the S&P, and all of that on the Dow Jones was totally given away as of today. Matter of fact, almost perfectly. The market closed low and last, is what they call it, literally giving away the entire Trump bump in the Dow. Well, that's kind of not good news, but if we were to look at the S&P, the Trump bump still has a little room left, but the bump is no longer significant. It is roughly about 0.5%. So there's no real Trump bump. Interestingly, by the way, our model on the S&P has been out since October 14th, middle of October. And we missed all of this move down and we missed this move up. And guess where the market is? Right where we sold it in October. So if we look at the way our product works, we weren't in the market for this long, almost over 2 months. And in that 2 months, the market has gone nowhere. So, and we have no risk during that time, where now the people, if you're in the market, you would have experienced some grateful new highs and made yourself happy. And then after today, you realize, oh my gosh, it's all gone. Bottom line is, the market has just given up a lot today. And you would think otherwise. And I didn't plan to talk about this really today. We knew this was going to be the FOMC meeting that I would have talked about. And today, the FOMC and cut rates 25 basis points more. And that cut, followed by who I think is a less than adequate Federal Reserve Chairman, he talked the market down 3%. What he's basically said, and why the market sold off today after a rate cut, no less than a rate cut, it sold off because the talk he had was that is the end of the cuts. There are no more cuts. And if there's going to be more cuts, the economy is going to have to stop heating up. The economy over the last 2 months has shown higher inflationary numbers in both the core PPI and core CPI, which are the consumer price index and the producer price index. Those numbers were coming in hot the last 2 months. And albeit 2 months does not make a trend, Donald Trump is not necessarily going to be inheriting a great economy. He is inheriting an economy that has embedded inflation. Now we have a market that has uncertainty. And more than that, we are looking at, if anything, higher rates. Take a look at this. This is the 10-year Treasury. We just broke through a major trend line holding the interest rates lower. In other words, this break to the downside here comes through a massive 4-year trend line. And look, if you're just a chartist, that tells me higher interest rates are coming. And that is something I definitely didn't even expect myself. But this move down to higher interest rates in the 10-year note was occurring on a day where the Fed cut rates. In my lifetime, I've never seen that. Normally, when the Fed cuts rate on the low end, you will see some easing on the long end of the curve. And we haven't. We saw an increase on the long end of the curve. That tells you investors are frightened. And keep this one in mind too. The bond market is 40 times larger than worldwide equity markets. In other words, the world bond market dwarfs the world equity markets by huge orders of magnitude. Basically, the world lives and builds itself on bonds, not on equities. Something to know. Why? Because the majority of people's cash around the world is in bonds. And bond rates look like they're going higher. What does that mean? It means 2025 is certainly going to be interesting. I was already kind of bearish moving into January, given that the market seemed very frothy. as we all know, the market kind of came up, the Trump bump, all clear sailing ahead, lower interest rates, inflation coming down, a pro-business administration coming in. We're going to have efficiency in the government with the new Doge committees. But today it was pretty much, I would use a different term, but it was slapped in the face. And the slap in the face was of an order of magnitude. I mean, these are large moves. Take a look at the dollar. I think not a good place to look at it, but I think we should look at it here. And the dollar went to the moon today. This is the highest I've seen the dollar since 2022, when interest rates were at their highs. That's what it means. What this is meaning is, by the way, we're almost at parity with the euro. The euro is only 3 cents worth only 3 cents more than a dollar. So if you want to go to Europe, this is a great time to go. Your money will go a long way. But what's happening here is it is disturbing to me. I think Trump is going to inherit some real problems that belie the success of the stock market over the last couple of years. I'm not making anything, I'm not saying we do anything here. However, we do have to be cogent that we're going to have probably a bumpy rest of the year, given what we saw today. I don't see an easy recovery. Let's just hope it settles out so Santa doesn't have to come and put coal in our stockings. We lost 3% today. The market was up 27. We're now only up 24%. That is, by all standards, a great year for the S&P 500. And it did it with very little volatility for the entire year. We'll go back and look at that. But I do think it's important, finally, before I leave this page, to note that the dollar really swung high today, which means people will move money into America to buy our bonds. And hopefully they do that, because if they buy our bonds, that brings the bond prices higher. And if the bond prices are higher, rates go lower. So let's hope that happens. We will see. Let me get back to the main page. I'm spending more time here than I would originally planned, because I originally planned to go over new portfolios. But today was a day of magnitude, and we must discuss it. If we go to the NASDAQ, let's take a look at that. Obviously, the NASDAQ lost the most today, 3.5%. But from the Trump bump, it is still up, generally approximately still 600, almost 1,000 points higher, from about 18,400 to about 19,400 or so today. So the NASDAQ particularly gained from the election. So that still looks steady. However, today was carnage. We will see what the next, the rest of the week brings. Hopefully we can steady out somewhere above this Trump bump, November 6th level, and maybe resume an uptrend. We will see. The banking, everything got hit today, so I won't go into the individuals. We know they all got hurt. And so there's really nothing more we can talk about other than this was a massive day down, created huge volatility, and it was unexpected because the majority of people coming into today knew that the Fed was going to cut rates 25 basis points. The market in the morning opened higher and it held its gains up until the time they made the announcement. And the announcement of the 25 basis point cut was followed by a sell-off to be about even. Then when Powell spoke, the market turned into this, basically what they call an SS. For everybody knows what that means, it's a shit show. And that's what we had today. Let's just again hope that this is not the start of something worse that the country has to worry about. The good news is, for the way we invest money algorithmically and using artificial intelligence, we will have less risk as the market starts to go down, if that's the case, and we will try to pick up stocks cheaper, hopefully sometime in the first quarter of next year, if that's the case. We will see. Some of the stocks, though, we'll do a quick run through of some of the stocks that did so well this year. I don't know where to begin because they all seem to do good and they all seem to recover if they did bad. I'll give you a start. Here's crowdfunding. CrowdStrike. CrowdStrike is a company that basically does IT, and it basically protects your website from hackers. Well, obviously, Microsoft and Oracle are customers of this company, and they got hacked. And so CrowdStrike went from around 400 a share to around 280 a share, and then, or actually 200 a share, and then it got picked up and went pretty much back to its highs, gave up a lot today, but we will see. Hacking won't go away. This kind of gives me some solace that this is still a company we want to own in the long run, and we do. Let's talk about another one. The cruise lines, I'll just do that again. Everything got hit today, so it's not the best day to look, but they've had a huge rally towards the end, from the end of the summer of this year. They've done well. That's still in people that hold the SPY portfolio. Let's look at another real surprise stock, AT&T. How boring, right? However, boy, when you look at a stock chart of AT&T, it sure looks anything but boring. It went from 16 a share all the way up to 24 a share, down to 22.50. Looks like a lot. It's only $1.50 off the high. That's a lot, right? $1.50 off of high of a $22, $24 stock, right? It's still about 8%. But it all happened today. It pays a dividend. It's a good stock to own still in the near term. Its little brother, Verizon, not quite as well, but still pretty good on the year-over-year basis. I mean, it did a little bit better than making money, but it paid 5.7% most of this year. So, and it paid it with very, very little movement in the stock. So if you get no volatility and I get 5.7% on a dividend, nothing wrong with that. Here's a stock that we've heard of. This is a company owned by Peter Thiel, Planeter. You've heard about it. You probably, if you watch the news, you'll hear about it. This is a company that essentially helps other company manage its technology. It has a unique approach to the markets, but it's doing extremely well. It's something I think we should consider, and it will be in some of our new portfolios as they change going into 2025. So look for changes in all of your portfolios, whether it's conservative or balanced or aggressive, and look for some new portfolios, which I'll show you in a little bit. Let's see, we're still good on time. Here's a stock that I also have mentioned, and it's gone through a huge correction, LandBridge. LandBridge, we did get some customers in it that were in some of the outside portfolios, but it went way up from October move. It went all the way up from 44 almost to 85, going up about 80%. It's just given back about 35%. And so these are stocks that I do like, and they will be a major component of a portfolio created next year, for next year. And the good news for us is if I still like it and our math works well on this, even though it hasn't been around a lot, this will be something that will show up in a new portfolio that we haven't given it a name yet, but it represents what our expectations are for a new administration and what they plan to do, which is going to be energy focused and Bitcoin focused. But in order to do some of these things, you have to have land, and you have to build factories on the land. You have to move energy over the land. You have to drill on land. These are the companies that actually own the land, and they get paid a stipend from all the other companies. For example, ExxonMobil or Energy Transfer, if you want to either drill on their land to find oil, or if you want to put a pipeline over their land to move oil. So we now know from the new administration that we are going to have a focus on energy. And that reason, of course, is to bring down prices. the prices that have been embedded, the only way they go down, like they did in the 80s when Reagan came in, is for a sustained push on prices so that wages don't have to increase as much in order to keep up with inflation. That's the problem that we had that was created by this administration, because aside from pumping $4 trillion into the economy, what was also occurring was that money went in, too many dollars chasing too few goods, and those goods started to embed their pricing. Like eggs will never be as cheap as we saw them before. Oh, maybe they will be, but it might take 5-6 years. Everything from a washing machine to a gallon of oil was affected by all the cash that slopped around our country. And of course, that's one of the reasons why our deficits went so high, right? We have too much money running around, and guess what? People are borrowing more than they have ever borrowed before. These things may come home to roost. And so far, the only thing that's come home to roost is the government has literally another $1 trillion of debt of interest on the debt per year. That is a huge amount of money. That's literally 1/28th of the economy. In other words, we have a $28 trillion GDP, and 1 trillion of it, that is just to service the debt. That is a real problem for any administration. And that was unfortunately really emphasized in the last administration. And Trump has to take some of the responsibility. But Trump was only there for COVID, which caused his portion. The problem that's occurred over the last 4 years was it was just made worse. It's going to be an interesting historical view of this administration, given the accolades they try to accept for a good economy, when in reality, this is an economy that reminds me of Swiss cheese. It may taste good at some level, but when you bite into it, it's hollow. And that's why I think the voters realize that, hey, man, everything we say it's good, but we clearly know it sure doesn't seem to taste good. Sort of like a burger commercial. You see the burger on TV, it looks delicious, but when you go in there and get it, it never looks like the one you see in a commercial. So that being said, there are still a lot of good stocks out there, some that like these that I like that have taken a beating, and we're going to be able to pick these things up a lot cheaper. And that makes me feel good. We'll see how that goes as the new year starts, and they are traded, of course, and managed by mathematics, and we'll see how the math works. But I'm still sanguine on these companies. Let's go to Bitcoin. We can't end the year without talking about that. Another thing that we all must understand, that when Trump was running for president, he made a statement that was a huge statement, and that's the statement that caused this particular product to go up literally 50% since he talked about it. Almost, you could make the argument it was up, 100% since he talked about it. You see this day here in November? This was right before the election. He made a statement that United States is going to accept Bitcoin, and it's going to be the world leader in Bitcoin technology, in management. They want America to be the leader of this product, of this new essential currency. That was a statement that I didn't expect to hear. Governments have generally been against this product because at many levels, on first blush, it is a threat to a sovereign's currency. But we've been through that during the year. We created the Bitcoin or the Bitflip portfolio to be able to manage the risk and volatility of this product. But we now know that it is going to be accepted going forward. In other words, there will be government agencies that will accept that. Right now, the government agency that manages Bitcoin is the CFTC. That's the Commodities Futures Trading Corp. They manage Bitcoin like it's a commodity. But the CFTC under a new administration may be all combined for efficiency reasons under a total financial services authority. That's the way it works in the UK. The UK has one authority to manage all types of securities. It's called the FSA there. We'll probably do something like that. But here in this country, we break it into separate agencies. There's one agency for insurance, another agency for securities, equities, and another agency for commodity futures and things like that. And there's 3 different agencies. Really, efficiently, it would only be one because they're all products that are things that people can buy and sell and get taxed on. So what's happening here, though, is Bitcoin has had a huge run up again as a result of a new authority coming in and saying, hey, we're going to accept it. So it went from essentially in around 60, in here when he brought it out in October, from about 66,000 and went all the way up to about 88,000, 108,000. And of course, it backed off today, but we're still over 100,000. My forecast, and again, I'm opining, and that's why we have a disclaimer out there, is Bitcoin very likely, as long as the markets are steady, the stock market is steady, Bitcoin very likely has a chance to double in 2025. Does that mean you should go run out and buy more? No. But it does mean that we want to incorporate that maybe a little larger into all of our portfolios. Currently, we do that in all of our 3 major core portfolios. That when you click a button, you get a portfolio, and in those portfolios, there's generally a 1, 2, maybe even a 3% allocation to the Bitcoin type product through the IBIT. IBIT is the symbol for Bitcoin in the securities market that we use as a proxy. The advantage of this is that if this thing goes up, we probably realize that we should own a little bit more of it. And so there will be adjustments going forward, even on the conservative portfolio, to earn a little more of this because it is an excellent decorrelator. And it is a product that I just can't find too many bear cases for it, that we really want to try to buy the dips. And so that's why we created the Bitflip portfolio, because we always own 50% core, and then we own the other 50% through an algorithm and AI that will trade it for us. And that has done pretty well this year. I think most of you know that. However, today was a bad day. There's no doubt about it. It was a huge loss even in Bitcoin. From 108, it literally is down significantly, almost 5% on the day. And that was because of the stock market sold off. So you can see at some level, there is a function of the stock market is embedded in Bitcoin. Not the total perfect decorrelator after all, but still, it's still inviting to most portfolios. Let's see. I think I'm coming to an end of the market recap. So I'll just recap it like this, and I'll get back with Lee and then show you a few things of the performance of this year's products. But the recap is, look, it was a good year despite the way it seems to be finishing the year. We're up 24% in the S&P. That is a great number. Even if we were to give away another couple of percent, maybe even another 4%, you have a 20% year up in the S&P. That's a good year. So don't be totally frightened from a little bit more further pullback if that's genuinely the case. Don't be afraid of that. But what we should fear is, at many levels, this is a frothy market, but that doesn't mean that things won't continue to bubble to the top. And so we really have to pay attention here and early next year on all of our portfolios. The thing is, our math does that for our customers. So I want you to know that math is behind it. There's a lot of stocks that are rolling out, and they will start to get out, and you'll reduce exposure if the market continues to move lower. So let's go into a different set of slides. Do you want to come in here, Lee, for a second and see if
I'll take your screen away while you get the other one set up. And there's a couple questions. One you'll want to chime in on, but sharing this question, I'll just show it while you're doing your
Sure.
thing. About 1099. So yes, we're no different than or using our platforms no different than a Schwab or a Fidelity. If you have a brokerage account or even an IRA that you take a distribution from, you'll get a 1099 sometime in January, February, somewhere around there, that you just include when it comes to your taxes. So I was just going to answer that in the chat, but others might have that question as well and wanted to make sure we covered it live.
Yep.
The only other one, Zung asked about Broadcom. He said, I'm not sure if you've talked about it before. Do you have any opinion on it or know anything about it?
No, I have no opinion on it. It's not one of the things we follow. If I don't follow it, that means we don't have math that we like that works on it. Everything we have, we want to have math behind it. The only exception to that is Bitcoin, where I have to use symbols like the IBIT that are generally new. And so I'm forced to use actual Bitcoin itself and say, how would we manage Bitcoin? And then I translate that over into managing a security that we don't have the same amount of data for.
Sure.
So
Generally,
Broadcom is, I've heard, of course, everybody knows what the company is, but I have no real thoughts on it. If you want thoughts on it, I always look at new things, even though that's been around for a long time. But there's been no math that excites us that says, hey, there's a value to trading and owning Broadcom. Right now, there isn't.
I know it's had a good December thus far, and the only thing, just to add to what you said at the start, like our set of stocks isn't necessarily in concrete. Like, every once in a while we get someone says, "Hey, go take a look at XYZ stock," and you'll run it through the system to keep it in layman's terms. And sometimes they work out. Sometimes the AI can't give you an advantage, and you're probably better off just buying and holding it, I guess, if you have that much conviction on it. So,
right. And to add to that, Lee, there's no look when you are trading some of your stocks. Trading is the wrong word. When you invest some of your stocks using a mathematical approach, it doesn't mean you have to use all of your stocks that way. If you have some of your stocks that you just like, you can hold them. And just remember that they will move whatever they move. If they go up 30%, you got it. If they go down 30%, you got that too. But in the context of an entire portfolio, a collection of stocks, if some of them are being managed in and out, you will find that the overall volatility of your account will come down. And that is really, again, it's a hard thing for most people to get and understand. It's not just about performance. It's just not. Performance, of course, is the thing we experience and feel, and we can either spend or tighten our belts. However, the real thing that matters is risk. How much risk do we want to take? We do not want to take the risk where our portfolio could go down 20, 30, 40%. If we want to take that risk, you can go over to Ken Fisher. Ken Fisher will give you that risk. The market goes up 40, he'll probably get you most of it. If it goes down 40, he'll give you most of that too. So I'm not interested in that. That's not the way our company is designed. Our company is designed around trying to maintain steady growth inside of its collections of stocks that you, as a consumer that uses our OMS, can click on. Makes it a lot easier for you. You're getting the advantage of a lot of mathematical approaches and science that's being used upon and placed into a OMS where you can click a button and get it all at once. You don't have to buy 10 things or click on 10 things. You don't have to pay a money manager. And you don't have to do anything. You can click one button and get the same kind of information and power that you could and do better than most advisors, in my opinion.
Yep.
So
and you don't have to be a Kelly. You don't have to be you to try to guess, and not that you guess, but for the average person to try to figure out the good time to get in or out of something. Like, we're just very bad as humans with our emotions and stuff and making good, I'll call them trades. So
right. That's what again, they are. Those are trades.
The AI makes us, very unique. Don't get me wrong, but I would say the thing that you don't get anywhere else, and not that you have AI elsewhere, but that will actually get you, or the AI will get you out of the market when things don't look worthwhile. Like everywhere else, you're in a buy and hold. So as Kelly's saying about Fisher, or really anywhere else, the market loses, so do you. So we don't want you to lose 20% like 2022.
Yeah, it's like, let me point one last thing out. I'm going to take a quick jab at Ken Fisher, who is obviously a billionaire. His companies made him $1 billion. And we've all heard the expression, we do better when you do. We do better when you do better. But what he doesn't tell you is we still make money when you don't do good. He just makes less. So he's not, it's so encouraging. We do better when you do better, but he doesn't tell you the other side of that. Whereas if you lose 40%, he still makes money.
It's just, and everyone else could say that too. It's a creative way to say, hey, I charge you a percentage of your account. As your account grows, I get more. And as your account goes down, I get a little bit less. So
that's right. But he's not taking the risk.
Right. No, and it's a brilliant. I see those commercials every once in a while. I'm like, man, that's good. If you only knew the whole story. So, all right, let's get your other screen up. They should be able to see it now. It looks like you're on the new Smartfolio. I didn't know if you wanted to start from the top, but I'll let you kind of take it from here.
I want to answer some of the questions and go back to that, because that's kind of what people want. Let's just, it'll be a quick rundown real quick. Let's take a look. Let me see how I'm not the best. I put them in a PowerPoint. Let me see if I can make them. My eyes are they're becoming worse and worse. How do I make that the whole screen, folks?
Let's just we'll keep it there, because I'm just,
maybe I could do it like this.
Yeah, you might be able to zoom there.
I'm going to zoom a little bit, and there we go. This is a kind of a good idea. So I took some screenshots. You can get these yourself. This one here is the conservative. The conservative portfolio, and again, you can see today was bad, the last day. But the conservative portfolio, these are the results basically of the year, approximately about 14.68% higher on the year. And that's actually pretty good given what was in that portfolio. It's supposed to be conservative. It's not going to beat the S&P. But what it's trying to do is, of course, pay you dividends and keep a consistent growth. It's generally used, conservative portfolios are generally for older people on fixed income. They're retired, or they're just people that just don't want to take a lot of risk. They don't trust the market, and they like the idea of having cash dividends, and rather make some money, pay your taxes on that, but keep it safe. This is a good year for a conservative portfolio, up almost 15%. And also collecting these dividends makes it even better. Two of the components in here, this is our All Plains American and Energy Transfer, which we have talked ad nauseum about throughout the year. But the reason we have is because Energy Transfer was up about 38% for the year as of about a week ago. And All Plains American was up just 22%. But the way they grew was extremely non-eventful. There was no pain ever in owning those stocks, and you got paid those dividends. Those are the kind of things that are in conservative portfolios. The other ones were, of course, AT&T, Verizon, things that had good appreciation this year and all paid dividends. That's why this was up 15%. Most conservative portfolios generally can't even be half of the S&P. This one was more than half of the S&P. So let's go to the balanced. Well, the balanced portfolio, it won't show today's loss in it yet because it didn't update in time when I did the conservative. But the balanced portfolio was up about almost 26%, owning it all through the year. And it had pretty consistent growth as well, as you can see. Now, not every investor got the 26%. That was only true is if you started on January 1st. So just remember that. So if you started somewhere else, it's going to be different. But I think most people understand that. Balanced portfolio is doing just as well as the S&P, which is great. It also pays some dividends. There's some dividends that come in there that will not show up in the performance of our balanced portfolio. So 25%, or sorry, 26% is pretty good. Actually, it's going to be lower than that after today, though, because it's going to be down probably about 1.5% because the market was down today, and when we post it tomorrow, it will be about 1.5% lower. So let's just call it 24 for now. But that's a good thing because that's where the S&P is. You always want to be able to be right at the S&P and take less risk. Finally, here's the aggressive. The aggressive obviously did well, but you can see the wiggle lately up here over the last couple of months area. This wiggle is because there's a lot more technology in here, and the technology stocks up until the election actually really weren't doing that well outside of NVIDIA. And this portfolio was only up an extra couple of percent more than the balanced. And again, today, this thing will also be down probably about 2% here when we post tomorrow at around 25% or 26%. Again, marginally beating the S&P 500, which to us is a massive victory. Remember, 90% of the money managers out there that you pay when they get paid better, they get paid more when you get paid more, can't beat the S&P 500. Just remember that too. It's, by the way, anybody that Googles it will find that to be true. So these are our three core portfolios. We have others, as you know, 4QR. 4QR was up less this year, 12% or so. I see someone doing it.
Oh, yeah, I was gonna. You kind of teed it up, honestly, earlier. I was gonna chime in and please don't take this as a personal attack, but this is exactly what you just said. So the question was, and this is only a part of it, but basically he's saying, made 12 or 13%, got in late March. Honestly, a lot of the market growth this year was in the first quarter. So if you take late March till now, the market's actually up about 12 or 13%. So
That's right.
That's basically exactly what it seems like the 4QR gotcha. That's not your whole question, but I just want to make it a point because it's very easy to see, kind of like Kelly said, oh, the market made 20 whatever percent this year. And even if you had, been invested 3/4 of the year, there's still a chance you could feel like you're way behind when in reality you're really not. So
Correct.
Again, please don't take that out of context. I know you have a question there, but I just want to make it a point. I know we've talked about it a handful of times, and hopefully it'll resonate because it is what it is. But I'll leave it at that.
That's a good one. And even though we can't see the scale here, the horizontal axis of time, you see this move up here, for example, in the aggressive portfolio. This was actually the first quarter area. So the first quarter was massive in the market, especially in the technology sector. But after that occurred, after the first quarter, the next 3 quarters in this area here, if you can see where I'm looking at, was obviously good, but it wasn't the first quarter here. So if you came in March, yeah, you're going to get more of this. You're not going to get this. Because that, again, everybody that starts at a different time is a different thing.
Yep.
So what
Kelly,
we're
let's get to your, sorry to interrupt you. Let's get to your other 2 slides there, and then we'll circle back and answer the rest of his question.
All right, let's get to this one. Okay.
Now you're really zoomed in.
No worries. Let's get to here, because here I'm showing you a picture of something that I drew from what we have a back end where I do all of our development. The development is very sophisticated, at least in my opinion. It's not the easiest thing to figure out, but one of the things we can do is we can combine equities, put them inside of a portfolio or as a collection of equities, and then we can analyze them through algorithms and machine learning. And when we do, and we apply that math, what we get is what you see here. What we see here is a portfolio, a brand new portfolio I created that I think will have the ability to prosper either as a buy and hold or especially with some level of risk control. I'm right. It's not going to be called Trump. You see the word Trump here? It's not going to be called that. But what happened is when Trump won the election, especially this way, and he has all three branches of the government, should be able to, for the most part, pass many of the legislation he may want to pass. We know what he's going to do. He has said it, and as a lot of people would say, take Donald Trump at his word. He wants to lower energy prices even further. And the way he's going to do it, of course, is he's said it a million times, drill, baby, drill. But if you drill for energy, what will happen is, well, you'll get cheaper oil, which means some of these oil stocks might go down a little bit because, hey, their product will be sold for less money. However, they're going to now be a net exporter. Right now, America is a net importer. There's no reason we have to. We could be an exporter. We were before. If we're an exporter, we're going to sell oil and all kinds of other energy around the world, which means overall sales will go up. If sales go up, even if the margins are lower, their profits likely will be much higher. So we want to be long energy again, probably for the next 2 years, regardless. Another thing we want to do is we want to be involved in anything that helps bring down inflation, because we know we're going to go after that. So what we want to do is own stocks that are providing infrastructure that could make things cheaper. I don't know about everybody else on this podcast, but I can say this: energy costs, like your electrical costs for your house or your gas costs, even though gas is super cheap right now, natural gas, everything has gone up. Everything. Yeah, I mean, my electrical bill, for example, is up literally 60%. I don't see how. The excuse in Arizona was that, they were going to put in price increases during COVID, but they got stopped. So in other words, from 4 years ago, I guess they were going to be 60% higher. They're just doing it now because they couldn't do it during COVID. We have to figure, in order to bring down inflation and bring prices down, not just inflation, that's just a number. But in order to bring down the actual costs of things, we have to make them cheaper. And there's a way to do it. And we want to invest in the companies that will make them cheaper. So there's companies that comprise this portfolio that will grow like this. So for example, this one you can see is only going back for 5 years, but you can see over the last 5 years, if you just look at both lines, the green line and blue, they're a little hard to see. They're up about 180% over 5 years. That's basically about 35% a year. Nobody's going to ever complain about that. And take a look at the way it occurred. There's no, outside of COVID over here, there's no drawdowns. It's basically a steady ride up. I suspect that the companies that made up this index are going to do something similar over the next 2 years. That may not go up 200%. The 2 is a percent. And that 2 over there. I suspect that over the next 2 years, especially since the new administration has all branches of Congress, of government, I suspect that there could be massive increases in the stocks that belie this index. And I won't tell you what they all are, but they do include like a land bridge, and they do include companies that are pushing towards Bitcoin, which is a little different than other costs and inflation, but we still want to be in it. So I'm doing something on things where Trump has made a point to say, so I want to invest in those kind of companies for the next couple of years, when at least he has control of all the branches of government. Obviously, that will be new. We will give you the name of that when someone tells me a better name than Donald Trump.
Maybe that's our gift card winner tonight. Who picks the best name for
Yeah,
this?
pick the name. What should we call?
So,
I got some ideas. Should we call it 47? Should we call
We've got 10 or so minutes, not to chime in too much.
I know.
Here, but
Let me do the last one and we'll go to questions. Here's the last one. I'm just going to show you this. First of all, we all know we put together Bitflip this year. We've done pretty well in it. The Bitflip portfolio has well, up until today, was up around 40%, which is good. Remember, we don't take the risk of owning Bitcoin itself. We only own half the Bitcoin, and we essentially micromanage through the mathematics the other half, trying to be in when it's a good time to be in. By the way, we're in 100% now, and we were in for the last since late last week. And as a result of that, we were very close to a profit take. However, that got spoiled today as the market came down. But again, that's the in business. I suspect that portfolio is going to do very well in 2025. No guarantees. And by the way, so Lee, that is it. There's the new portfolio. We got to have a new name for it right now. It's going to contain these symbols. Here's one we just assembled. There will be another one called IDefi, something that will be something around things that are not finance orientated, things that are new kinds of finance, Bitcoin, blockchain kind of things now that we know are going to get support from the government. So we'll have another. So there'll be 2 new ones and maybe 3. And there will be many changes to the existing ones sometime in the first quarter of next year, probably January. They will not occur before the end of the year for tax loss reasons, but they will occur early next year. And on that, Lee, I think I am done with what I can show.
Perfect. Let's circle back to that second part of the question about 4QR. So, and obviously we can't give advice here like the disclaimer says, but he's asking basically, if I want max growth, should I stick with 4QR, switch to SPY Plus? I'll take it a step further and say, what about any other Smartfolio? Like, is aggressive more max growth than 4QR? Obviously aggressive is probably
4QR can be the most aggressive one and at times, and the least aggressive one at other times. So in a down market, 4QR is going to be looking for the things that are holding in there and not going down. In an up market, it's going to be looking for the things that advance in the most non-volatile ways. I think for 2025, and again, all opinion, right? But I'm allowed to opine. As a software company, we can opine about what our OMS allows people to click buttons on. I really would look at what will eventually be the Trump portfolio, which we won't name it that. Again, I don't like that name. I think that'll probably have, great opportunity for next year. I'm also thinking that, the technology stocks have been so hot. And right now, I still am, of course, optimistic about technology. But if it's me, I'm kind of thinking, I would have less towards, big tech and aggressive, and probably more towards balanced and in the beginning of the year. But any of them will manage it because of the math. The most aggressive one for next year will be either the aggressive by its name, by virtue of its name, and whatever's in there, or what might be the new portfolio I just discussed. I think those are going to be the most powerful ones for the next 2 years.
Perfect. To maybe segue off something you brought up earlier, a question I get a lot is, how often do the contents of the portfolio change? In my estimation, it's maybe once or twice a year at most. I think of when Boeing got replaced, when they had that crazy news. Obviously, you're going to retool the portfolio a bit start of next year. I don't know if there's anything else you want to say there.
No, you're correct. Generally, I look at the portfolios all the time, and we're doing mathematical testing in the background all the time. And sometimes when we come across a symbol that we know has high probability of successful trading and management using our science, we will look to replace something that is doing the worst inside of one of our existing portfolios. And it may show, for example, AT&T might be in 2 of our 3 core portfolios, and we might replace that AT&T symbol with the new symbol. because it has better performance and also better risk characteristics than AT&T.
Sure.
So that's how it's done. It's not too often that we do it, and there's a reason for that. The idea is to try to hold positions. We're not here to trade. We're here to invest, but there are times when your investments need management, and those things occur periodically. When markets start to correct, you do need to get out. It is a better bet to take any kind of a profit and pay the taxes on it than to continue to hold something and make no money on it. So
Right.
I'd rather take the profit and pay the tax than lose the entire profit and say, oh, I didn't have to pay any taxes.
I would agree. That question comes up more often towards the end of the year, when people get into tax loss harvesting and all that sort of stuff. So just a comment from Kamal. Thanks, Kamal, for joining tonight. Glad it seems like you got some value out of it. And then he said his new name that he proposed was Momentum Portfolio. I know momentum can mean a lot of different things.
I thank you, Kamal, but I don't want momentum is not the right one. I really think it should be something that points towards unified government or direction. We're talking about a secular move as a direction from a person that you have to take it as word, and but you have to interpret him correctly. And I think he's pretty easy to interpret. I don't think he's a boogeyman. I think people say things off the cuff, and but I think they really are sincere about it. So thanks for that one. Give me another one, man.
I think we're gonna wrap it up here pretty soon. Honestly, there's only a few questions tonight. Someone said, how about concept portfolio?
Better. I like that one because it is a concept. It's a motif, actually. That's one of the things also you'll note about our platform is I do plan. Look, every time we put a portfolio up there, it really is a motif. It is a sub-story inside of a novel, right? Most novels have many characters, and each of those characters are developed in their own way. And each of those developed characters is a part of a motif. So motifs, many years ago, there was a company that did this, and they said, here's a motif. War breaks out in the Middle East. Well, that's actually occurred. What's going to happen? So
right.
you build, say, well, then oil prices should go up. So I create a portfolio of, say, a bunch of oil stocks, and we call that the oil, Middle East war. What does that mean? Click. Oh, if the Middle East war. So we're doing things more like that. I really do kind of believe in that. So this is a kind of a marriage between science and common sense. But common sense is great. The science is there to really manage things because it's hard to manage all those things simultaneously when you're looking at 50, 60 symbols, maybe in our case, hundreds. Can't manage them all. It has to be done by a computer. Yep. So look for more of that.
Cool. And Randy, sorry I didn't recognize your YouTube name. He said who it was. Roderick had a question. I think it was on the two new Smartfolios you were showing. He was just asking if it was back testing. So I know the Bitflip stuff we have all live data on since February-ish of this year, when IBIT was created. How about the rest of it? Go ahead.
Well, of course, all things. When you remember the screen I just had up,
it's all right. You don't need to reshare it.
I won't. Yeah, I won't bring it back up. That screen I just had up, that is a back test. That's exactly what a back test is. A back test is just if we see these 10 stocks and we just combine them and we look back over history, how did they do just buying and holding them? Yep. And then we look back over the same history. How would that have looked if we used our mathematical approach to it? And then we have that second grind. One of those lines was just buying and holding it as a back test. And the other one was, hey, we got in and out of the items in that portfolio through that same period. How does that one look? That's called a back test.
Yep.
Back tests are meaningful to get an idea for things, but they have no concept of the future.
Well, you have to be careful with them, right? Because you could back test something to make anything look good. It doesn't mean it has any value moving forward.
If I just back test Apple on a buy and hold, that looks pretty good, right? Because Apple's done so well over the years. If you back test Apple using a rules-based algorithm, it doesn't do quite as well, but it has much less volatility.
Yeah.
So which one do you want? The advantage of the back test using science is because there's no guarantee of future performance based on past performance, but there is a huge value to a back test in getting a general idea of expectations of how, for example, money management rules work when you apply them over the data. So a back test, I'll finish with this one to make it short. A back test of buy and holds of a collection of stocks is extremely accurate because we already know what the prices are. It's true. And if it's upward sloping, you could probably make an assumption it'll continue to do that, but there's no guarantee, right? Whereas if you do the same thing and you're applying the math on it, you can say, well, it's only theoretical because you don't know if you could have made that trade back, 2 years ago and got in then and then got out later. You don't, but it really, you do it, and it actually does set the stage for the way it should perform on a go-forward basis. So back tests are extremely valuable. They give you an idea of concept, but they don't represent the final truth because we just have no idea where the markets are going to go. But what we do know we can do is we can get out of them if they're going down.
Yep.
That is something we do know, and we can get back into them when they're going back up. And that is something that's not that hard to do.
Perfect. And if you'd see the screen, Roderick also said this was his idea for the name MAWA, Make America Wealthy Again. I don't think anyone would disagree with that.
Yeah, I don't mind. MAWA, Make America. Yeah.
All right, Kelly, were there any gift card giveaway worthy questions tonight? We're going to wrap it up here.
Oh.
With the one on Broadcom,
I might need any miny, mo.
Yeah, another one asking about the 1099 and then the 4QR portfolio and if it's the most aggressive.
Let's do the 4QR one because the main thing on that is, again, when you look at a chart, you look at a chart and you see, hey, this is what 4QR did for the year. That means you assume you started on January 1st. But if you started on, March 25th, it's going to be from March 25th on and whatever happened there. So you're not going to have the exact same result. That's true of anything. If the market was lower when you bought it, you'd actually do better. And if the market was higher and you came in later in the year, then you would do not as good. But you would at least follow the performance of everybody else from the day you bought it. That's what's really important there.
Sure. Well, perfect. Well, Zung, and I'm probably saying your name wrong. I'm sorry, I mess it up every time. But you're our winner tonight. So congrats on the gift card, just in time for the holidays. Maybe get yourself something nice as well. So you already know me fairly well, but just send us an email at mailbag@iflipinvest.com. Our team will just email you the way to receive your gift card. Other than that, Kelly, any final thoughts? I actually have to jump soon, but
no final thoughts other than this. Look, it's been a good year, everybody. I think we should try to enjoy the holidays. Don't be so frightened about what happened today. In this particular case, I can see it. It is a froth, and they're just working that out of the market. It might go a little bit lower. No matter what happens, it's still going to be a good year. Unless we have like another 5-6 days of this, then it's going to be a totally different thing. We will be out of a lot of things in the markets. And the final thing I'll say outside of Merry Christmas is anybody some of the people are saying, hey, I need some help. Those things, hopefully you put in your tickets and you can get help with your accounts through ticket systems. and any of the other ones, thank you for some of the things that are said, and as well. I'm grateful for all of you, and I'm grateful to be able to help anybody that is using our platform. And again, finally, Merry Christmas, and have a Happy New Year, and I'll talk to you next year.
Awesome. Well, yeah, it was a great year in the markets. I think it was a great year for the AI Circle. We had a lot of folks that joined us every night. We thank you for that. Enjoy the rest of your 2024, and we will see you probably the first week of January. I'm thinking the 8th is going to be our next AI Circle. So in the meantime, enjoy yourselves, enjoy spending time with family, enjoy all the holidays, and have a great rest of your